Welcome to Chapter 23 of Essentials of Healthcare Finance, Developing the Cash Budget. In order to minimize costs and plan ahead to finance deficits and invest excess cash, a healthcare organization needs to clearly identify the timing of its cash inflows and outflows. The cash budget is the best way to plan for these cash flows. It helps management determine whether additional financing will be needed, in what amounts, and for what duration. This information also will reveal whether it will be possible to invest cash surplus on a short-term basis. This chapter describes the cash budget and how to prepare and use it. The learning objectives are to explain the importance of a cash budget, explain why an organization needs to carry cash balances, list and describe where cash is generated by an organization and where an organization uses its cash. And finally, understand how to prepare a cash budget. The key source of information to determine the firm's short-term needs for cash is the reason for a cash budget. It allows management to manage its liquidity position through increasing level of cash and investment reserves, restructuring maturity of existing debt, and arranging a line of credit with a bank. The primary need to maintain cash and investments is for short-term working capital needs, capital investment needs, contingencies, and to supplement operating earnings. In 2016, the average not-for-profit hospital held 20 to 30 days of short-term cash and investments to meet short-term working capital needs. Most healthcare firms should carry about 20 days of expected cash transactions at any point in time. For example, to cover payroll and supplies, things of that nature. Capital replacement and contingency funds require high cash needs. Not-for-profit healthcare firms must routinely set aside cash for replacement and renovation of existing assets because they have no access to equity capital markets. The amount to be reserved for capital assets in not-for-profit firms depends on the percentage of debt financing to be used or projected future levels of capital expenditures. Investor-owned firms access capital from equity investors, for example, the issuance of stock, who decide whether or not to supply more capital based on the expected return. If debt financing is limited, larger sums should be set aside for replacement and expansion. Absence of debt reduces future financial risk. The board establishes levels of debt financing based on trade-offs between the risk and the firm's need for capital. Access to debt, usually related to historical and projected financial performance and through credit ratings. The not-for-profits with high levels of cash have greater access to debt financing at lower interest rates through higher credit ratings. Projection of capital expenditures have two main factors: routine replacement needs and strategic planning of the firm. A common method is based on allowances for depreciation. If all of a firm's existing assets were to be replaced, if there were no inflation in replacement cost, and if no new capital assets other than replacement items were purchased, the present allowance for depreciation balance would be an accurate estimate of future capital expenditures. An allowance for depreciation example is a digital mammography unit that's acquired for $500,000. Its estimated life is 5 years. The depreciation rate, therefore, is $100,000 per year. At the end of the first year, the allowance for depreciation would be $100,000, and it would increase each year by $100,000. Funding depreciation is a program that's adopted by not-for-profit hospitals without access to equity capital. For the previous example, the hospital would place $100,000 in a fund each year. At the end of the 5-year useful life, the hospital would have $500,000 available for replacement, assuming there was no pricing increase. Most replacement capital assets do increase in price, however. Projected capital expenditures usually exceed present allowance for depreciation balances. To adjust the forecast of capital expenditures, an inflation factor is usually applied. The present allowance for depreciation balance is increased at some projected inflation rate, compounded at the average age of the firm's present capital asset. Contingencies are unexpected demands for cash flow. The amount reserved reflects tolerance for risk and estimates of unexpected cash demands upon the firm. Examples would be underfunded pensions or professional liability claims where payment is required at a future date or this investment is over and above short-term working capital needs. Supplemental operating earnings provide dependable flow of investment earnings that can be used to supplement expected weaknesses in operating earnings. They're also called operating endowments. They're adopted by some not-for-profit U.S. healthcare firms. They may be adopted when significant deterioration in operating earnings is expected. Sources of cash include collection of accounts receivable, cash sales, investment income, sale of assets, financings, and capital contributions. Uses of cash are primarily seen as payments to employees, payments to suppliers, payments to lenders for interest and principal, purchasing of fixed assets, and investments. Cash flows are not equal to income. The amount reported for revenues in a given period of time will not equal actual amount of cash that's realized. In most healthcare settings, there is a lag between recording of revenue and collection of accounts receivable. Similarly, expenses for wages, salaries, and supplies may not equal the amount of cash expended within a period of time. The volatility of cash flows determines the length of cash budgets, for example, monthly versus quarterly. Cash budgets are routinely revised due to inaccuracy of original budget assumptions. The greater the degree of possible variation between actual and forecasted cash flow, the higher the liquidity need of the firm. When preparing a cash budget, the revenue forecast is the most important component. The revenue forecast is determined by volumes by product line and expected prices by payer category. The volume estimation method is done through subjective forecast and statistical forecasting. Subjective forecasts are referred to as seat-of-the-pants methods. It's wisdom and understanding of the forecaster that are crucial. It may be most reliable when future volumes are likely to deviate from historical patterns. Future prices can be predicted based on some mathematical model extrapolated from the past. Challenging for healthcare firms as they rely on other entities to determine prices, for example, Medicare and Medicaid. Due to large volumes of Medicare and Medicaid business, even small changes in prices may cause forecasting errors and have major impact on the firm's cash flow. A common way to project cash flows is through the use of decay curves. Decay curves relate future collections to past billing. Consider this collection pattern as an example. The first 15% of any month's revenue is collected in the first month. The next 30% is collected in the second month, the next 25% in the third month, and the next 20% in the fourth month, and the next 5% in the fifth month. The remaining 5% of any month's revenue is written off and not collected. After forecasting cash receipts, a schedule of cash disbursements is necessary to complete the cash budget. Labor and payroll is often about 60% of your total expense. Payroll expenses are monthly, but most disbursements are biweekly and must be adjusted for withholding and other deductions, for example, payroll tax, workers' compensation, unemployment, and Social Security. And supplies, which is similar to labor and not equal to actual supply disbursement.